everyone, and thanks for your time today. I'll be discussing what happened in markets last year, how our funds have performed, and what we're planning for the year ahead. I'm pleased to say that we've had another strong year, and our funds have once again delivered healthy returns for members. We've achieved this results despite some challenging conditions and notable headlines. In short, our strategy remains sound, even in a changing global environment, and turbulence in markets was not as pronounced as the headlines might suggest. To explain this in a bit more depth, I'll be speaking to you today about the major economic drivers we've seen over the past 12 months, how we've navigated those conditions, and finally our outlook for the year ahead. I'd also like to quickly note that I'll be speaking to fund returns for the calendar year to 2025. These returns are more up to date than the financial year returns to June 2025, which you may have seen in recent member statements sent to you. However, if you haven't seen our 2025 financial year numbers and would like to review them, they're available on our website. Inflation continues to be a factor to watch in markets after spiking during the COVID period. When it first returned, most commentators expected inflation to be transitory and the underlying pressures would pass quickly once supply chains normalised. Now, unfortunately, it soon became clear that higher prices weren't going away quickly. Last year, we made several observations about inflation, noting that it was indeed declining, the rate of that decline was decelerating, and this slower pace of decline would likely slow the pace of cuts to official interest rates. As a result, we expected inflation to moderate over the year, but central banks would remain slightly wary about inflation levels remaining a little high. This caution on inflation by central banks was proven correct here in Australia with a higher than expected CPI data for December 2025 quarter, now putting upward pressure on cash rates. This generally proved to be the case globally last year, with cautious cuts to cash rates from central banks as they monitored the trajectory of inflation. One notable difference has been the impact of US tariffs on prices and the knock-on effect that's had for inflation. There's been significant focus and media attention around the issue, particularly following President Trump's Liberation Day announcement on April 2nd, 2025. The original plan was to implement a 10% base tariff rate on all countries. Additional individual reciprocal tariffs were then intended to be rolled out from April 9th. Markets reacted negatively to the tariffs. The rollout slowed and deadlines were extended while individual deals were negotiated. Now, the reality to date is that headline tariffs announced by the Trump administration haven't fully flowed through to end consumers. There's been a lot of substitution and rerouting of US imports, and the actual effective tariff rates have been much less than the headline rates announced. Additionally, the US administration has reduced tariff rates for many countries, and businesses have absorbed some of the tariff costs. For inflation, that meant prices haven't seen a big spike up as feared, but at the same time, prices haven't come down as much as we'd like either. Now, that gave central banks a bit more freedom to cut interest rates, and we've seen a handful of cuts from central banks around the world since then. For equity investors, the returns this year, the big driver was the rapid rise of AI. AI adoption has grown more and more as businesses and people adopt it in their daily lives. That translated into exceptionally strong investment in AI infrastructure and meant big returns for AI hyperscalers and AI adjacent stocks. For the 12 months to August 15, just 4 companies accounted for 60% of the stock market gains, these being Nvidia, Meta, which is Facebook, Microsoft, and Broadcom, which is another semiconductor manufacturer. Now, that's led to some talk of a bubble, and I'll get into our view for the coming year a bit later during this session, but for now I'd like to note that if you compare what's happening in the AI sector today to bubbles we've seen in the past, there are some key differences, and we think some of these bubble fears may be overstated. If you compare the AI boom of today with the dot-com rally and subsequent crash in the early 2000s, much of the run-up in prices back in the dot-com era was driven by speculative capital, often partially funded by debt, pouring into companies with no underlying earnings. Now, these AI companies we're seeing today are in many cases backing up their share market performance with solid earnings, and notably we're expecting to see those earnings broaden out to other sectors both in the US and here in Australia. So we don't see it as a clear bubble yet, but it's something we're watching very closely because valuations are clearly very high. We still see some room for AI stocks to run up, but we'll keep an eye on further developments. Last year I commented that we were positioned relatively neutrally on shares. We subsequently moved to a small overweight position in global shares. Now, while we don't expect to see a repeat of the 2023-24 stellar returns, we did expect to see modest positive returns given earnings growth remained relatively healthy and cash rates were expected to ease. As it turned out, that decision was a good one. Global equity markets have been strong, delivering 19.7% on a currency hedge basis for the calendar year and serving as a key driver for portfolio returns. We've also seen fixed interest do reasonably well, supported by the moderation of those inflationary pressures we've been watching over the past few years. Private credit's performance has been very healthy over the year. We've continued to build resilience in our private credit investments by further diversifying holdings, moving from a focus on Australia to a larger proportion of US-based opportunities. There's a couple of reasons why we're doing this. The US is a deeper market with more opportunities to invest, and we work with some excellent private credit managers that help us seek out really great opportunities. And of course, the benefits that come from diversification. That helped us generate a one-year gross return of 5.6% to 31st December 2025 from our fixed interest portfolio, which compares very well to fixed interest returns from other funds. It's been a strong relative performer for us this year. We've also been expanding our unlisted infrastructure program and investing in more of what we call core plus assets. These are high quality infrastructure assets we expect to deliver higher returns. As with our fixed interest portfolio, we've further diversified our infrastructure holdings too. For members in options that include unlisted infrastructure, this means your super is invested in assets like Heathrow Airport, one of our more recent additions, and an excellent asset we're very pleased to be invested in. It's a large, long-life regulated infrastructure asset with strong, stable cash flows. The airport also has significant growth potential, and we expect it will contribute to the long-term performance and resilience of members' portfolios. So with this in mind, how did our default option perform? Our MySuper growth portfolio, where most of our MySuper members are invested, returned 9.6% over the calendar year to 31st December 2025 and has delivered a very healthy 8.4% per annum over 5 years. These returns are very competitive when compared to other super funds. Looking at the Super Ratings SR50 MySuper survey to December 2025, which compares returns from some of the largest Australian MySuper products, MLC MySuper growth portfolio was well above the average fund return over the 1 year, and more importantly, over 5 years, it is the third highest returning fund of the 38 funds covered by that survey. These returns are net of investment management fees and tax and before administration fees. These results were mainly driven by the portfolio's exposure to global share markets, which have remained very strong, supported by lower interest rates, continued investment in the technology sector, and strong growth in corporate earnings. The portfolio also includes a diversified mix of alternatives and unlisted assets, such as infrastructure, real estate, and private equity. These are investments not traded on traditional public markets. They're really helping to spread the risk and support long-term growth. This diversified approach means your super isn't relying on just one part of the market to deliver returns, making it more resilient through market ups and downs. So what are we expecting for the year ahead? Firstly, the outlook for growth remains positive. We expect the current moderate pace for growth to continue a little longer, but anticipate a modest pickup in 2026. What is interesting about the current growth story is that it's likely to be a relatively jobless expansion, driven in part by AI efficiency gains. The rollout of these AI solutions is expected to help labour productivity. Over the next 12 to 18 months, we expect to see growth and spending accelerate, but potentially without a big increase in hiring. Now, we view this as a healthy scenario for markets. Such an expansion would be strong enough to maintain earnings, but is unlikely to trigger wage push inflation, which is when business have to increase wages to attract employees and pass those wage costs through in higher prices, adding to inflation. Looking at inflation more broadly, we're expecting price hikes to moderate as US inflation continues to track lower. As I flagged earlier, the US tariffs have added some pressure to the prices of core goods, but the effective tariff rate remains well below headline tariffs that a lot of people have assumed. We think that about 60 to 70% of the tariff-driven adjustment has already happened, and of course, the US approach to tariff setting going forward is difficult to predict, with threats of increased tariffs being used as a lever to drive wider policy objectives for the US administration. Against this backdrop, we think underlying fundamentals for equities remain healthy, and returns could do well. However, we believe that valuations are high in some areas of the market where prices have become a little frothy. We're growing a little more cautious on Australian equities at the moment, Much of the strength we've seen in Australian equities has been linked to big gains by a handful of heavyweight stocks, including Commonwealth Bank and Chinese demand for Australian commodities. That growth story has supported our equity holdings over the past year, but we're less convinced about how that might fare in the year ahead. International equities still have the potential to move higher, and we hold a small overweight in global shares. However, our weightings towards certain sectors might shift somewhat. As I mentioned earlier, we're watching AI and AI-linked stocks for signs of overextension. Now, these expectations are all derived from our base case expectation for the next year, that the US economy will experience a modest pickup in growth over 2026. We put the likelihood of a recession in the US at only 15%, but there's a couple of risks to this scenario. If we see an acceleration in trade tensions or a significant policy misstep, we could see the likelihood of a recession increase. Likewise, labour market weakness could also turn into recession, though we don't think this is very likely. On the flip side, we could see a situation where growth accelerates at a more rapid pace, potentially putting extra upward pressure on inflation. This is another risk case we're considering. There are also several geopolitical risks we're keeping an eye on. Oil price fluctuations driven by tensions in the Middle East, trade war risk, bond market volatility linked to high levels of government debt, and even the possibility, though unlikely, of an Australian recession. Those are all downside risk cases we're watching for at the present. So all in all, this has been another strong year for us, and we're pleased to have delivered strong performance for you. Building up your retirement savings remains our number one priority, and I'd like to thank you not just for your time today, but more importantly for entrusting your savings to us. Super is a long-term investment, and for most Australians, we know it's often one of the biggest assets they'll own, and we deeply value your trust in us to manage this on your behalf. I'd also like to take a moment to thank our investment team for their dedication and hard work this year in managing your portfolios. Looking ahead, I'm confident in their ability to continue to deliver solid performance over the long term and to help you achieve your retirement goals.